This is week two, problem three, part two. We have the balances on each of these accounts or sub accounts, and we have our the total of our assets and our liabilities plus owner's equity. Now we're gonna start with the income statement. Now, just so you know, I believe this is Louise's company, so that's what we're gonna write as the name, company. And then the second line would be the actual financial statement. In this case, this is the income statement. And then finally, this would be for the month of, and I'm assuming it for the month of December of 2011 or 2013. Then basically we know that the income statement is your revenues minus your expenses, and they do have plenty of revenue, so I'm going to insert a few rows here so that way you kind of know the different kinds of revenue. So we have delivery fees, we have delivery fees. I want to be able to spell correctly here. And then we have delivery fee. Make sure you indented. And delivery fees. And these can be in a line. It'd be great if they are in a line so that way they're all equal and they all look nice and neat. Okay. And then we have the amounts, which I'm going to put them right here. So the amount of the first delivery fee, which is our revenue, it is 13,500. The second one is 10,000. The third one is 12,000. The fourth one is 7,500. So your total revenue, which will be up here, is the sum of these, which is 43,000. And then we have expenses, which is minus your expenses. And as far as expenses, we have drawing is not considered an expense. So we have utilities expense, rent expense, and telephone expense. So utilities expense, rent expense, and telephone expense. All right, and then what we'll do is and then we have utilities expense, which is equal to 1,600. Then we have rent expense, which is 2,500. And then we have telephone expense, which is 650. All right, so total expenses, and expenses. I'm gonna put them right here. The sum of these, 4,750. So basically, if you want to know whether or not you have net income or net loss, you take your revenue, your total of revenue, minus your expenses, and you have a net income of 38,250. Then we have the statement of owner's equity, kind of starts the same, and the way that it starts is Louise's company. I'm not gonna grade you on spelling. The second one is the statement of owner's equity. And by the way, I will take points off if you don't include this. Make sure you have a good, proper financial transaction history. So this would be the good, correct statement of owner's equity for the month of December 2000 so. And then you'll start with your initial capital or initial investment. And your initial investment is equal to, all right, let's see up here, it is 65,000. And then you want to do plus your increasing capital, which is basically your net income or net loss, which is this one right here from the income statement. However much you withdrew, so your minus your drawing. Actually, this would be your net income. net income for that month. And then your drawing would be, nope, not T accounts, would be 1,500. Now your increase in capital would be however much you made minus your drawing. So your increasing capital is 36,750. So as of January 1st, your actual capital will be the one that you invested in December plus your increase in capital. It would be 101,750. So capital as of December 31st, and not December, but it'll have to be a date here, 31st. It's 101,750. I'm assuming this is the same thing. If I haven't put it, all right, we got to do December 31st here as well. Okay. All right, then we have the balance sheet, and the balance sheet is the same thing. So we have Aloysius Company, and then we have balance sheet, and a balance sheet is only for one day, is, as of December 31st of 2000 and whatever date it is. And then we have, as far as assets, we have cash, we have account receivables, and you know what I'm going to do? Yeah, we have account receivables. Then we have, I believe, well, what else do we have here? Cash, account receivables, supplies, prepaid insurance, office equipment. Supplies, prepaid insurance, and office equipment. Let's see, I don't think we have anything else. I don't think we have anything else. All right, so we'll start by including the actual amounts of assets. So the amount of cash is 64,150. The amount of account receivables is 28,000. The amount of supplies is equal to 3,000. Prepaid insurance is equal to 1,600, and then office equipment is equal to 12,250. So this would be the sum of these right here. So your total assets will be 109,000, and then you have total liabilities, which is equal to, well, you have accounts payable right here, accounts payable, and accounts payable would be equal to, all right, it would be 7,250. So this would be equal to 7,250. Your owner's equity is equal to, you go back to the statement of owner's equity, 101,750. Your total owner's equity is 101,750. Your total liabilities plus owner equity is this, plus your total liabilities, it'd be 109,000. So basically 109,000 is equal to 109,000. So the left side of the equation is equal to the right side of the equation.